If you had invested $10,000 into the S&P 500 in 2015 into a fund like VOO, that $10,000 would be worth over $32,000, even if you hadn't added anything more to it. But if you had invested that same $10,000 equally among the Magnificent Seven stocks, you would have over $407,000 today. It's a solid annual return on the S&P 500 at just over 12% every year of those 10 years. But it doesn't compare to the Mag 7 with a compounded annual growth rate of 43% each year. Now, it is not my goal to downplay index ETFs like VOO at all. They are fantastic for every level of investor. But if you choose to invest wisely in some of the top companies like the Mag 7 that have strong fundamentals with solid leadership and growth, then you stand to earn substantially more over the long term. But what if you want to invest in only the top 4 companies just to keep things simple? Which ones do you choose? That's why I'm going to cover each of these magnificent stocks to map out which ones are the most undervalued or overvalued today. And when I provide the 1, 3, and 5-year price projections, it's going to be based on a blending of the analyst averages and also the discounted cash flow model. And they are projections based on the financials that are available today. So they're only going to be given as general information for educational purposes. And just to make things interesting, I'll be covering them in the order of Mama Ant. But before I dive in, if you get any value from my videos and my spreadsheets, and if you feel that I've earned it, I would really appreciate it if you'd press the like button so my content can continue to grow. Let's begin with Microsoft, where I'll start by showcasing their revenue by segment and their last quarterly earnings. And I want to highlight that their Azure server and cloud are up 22% year over year, and their cloud business makes up 38% of their total revenue. This is important because I'll be comparing the cloud businesses of Microsoft, Google, and Amazon throughout, and I'll be comparing them at the very end. From here, their next largest segment is productivity and business process, being up 10% year over year and making up 58% of the mix. And when we compare the margins of these 3 areas, the bulk is made in the productivity area with the cloud right behind it. So based on these charts, the bulk of the revenue and the margin is productivity and software. And this is the area that Microsoft needs to grow the most. And that's why they're pushing their commercial 365 Copilot programs so heavily. And this little upsell is going to be worth a few extra $1 billion each year. And with their intelligent cloud business growing the most, it may bring their overall margin mix down just slightly as it begins to catch up to the productivity software, but it does drive up that overall revenue. And in their personal compute space, they are working to increase margins by shifting more to the subscription-based gaming and cross-platform sales to expand their audience reach. This gives Microsoft great footing for their stock forecasts. And remember, I am taking a little bit of a mix with the analyst forecast and also the discounted cash flow model. At the 12-month forecast, analysts have it at $506 with over 14% upside. The DCF, or discounted cash flow model, is at $504.90. which aligns toe-to-toe with analysts. Regardless of the final 1-year stock growth for Microsoft, the question that I ask myself is, do I think that it's going to outperform the S&P 500? And my answer is yes, I honestly think it will. And when I run the DCF model for the 3-year, Microsoft comes in at $644 with around 46% upside. And when I ran this DCF model, I used a free cash flow growth rate of 13%, which has been atypical for Microsoft. And I happened to use a target price free cash flow multiple of 46.75, where I'm simply showing you the equation and the assumptions so that any of you that are hardcore investors understand my methodology. And I won't bore the rest of you by showing any other equations throughout the video. And for the 5-year DCF model forecast, it comes in at $823 or 88% upside. Overall, Microsoft has awesome fundamentals and they're still growing at a very strong pace, where their AI investments in Copilot should truly be paying off in the near term. Next, we'll move on to Alphabet, also known as Google, where we'll be diving into the breakout of their revenue, where Google Cloud grew the most at 28% year over year and making up over 13% of the total mix and still growing. And the next highest growing component is their subscriptions and devices being up 18%, but it only happens to be 11% of their total revenue mix, so its impact is a little bit lighter. The bulk of their business is growing at just over 10% year over year. And Alphabet did take a recent hit on the stock price when Apple announced that their search was shifting to AI and a little less on Google. But Google's Gemini AI is proving to be one of the best LLMs on the market, and they're at the forefront of incorporating it in all of the Google ecosystem. For their 1-year forecast from analysts, it's at $198 or 28% upside. And the DCF model is much higher at $249 $46, or up 60%, which does seem very high, but I am using the same math here. At the 3-year, the DCF model comes in at $263, up 70%, and the 5-year forecast comes in at $334, up 116%. And keep in mind that I'm sharing these discounted cash flow model forecasts for directional purposes. It happens to be based on today's numbers and today's assumptions, where any given lawsuit or bad story or even new technology could change this in a single story. So my point is, take it with a grain of salt. And once again, do I believe that this is going to outperform the S&P 500? And my answer is yes, I absolutely do. Before moving on, I have a quick quiz. Between 2000 and 2024, do you know which company had a stock growth of over 131,000%? It's not a tech company. It happens to be Monster Energy, which leads me to today's sponsor, Safety Shot. They're the world's first patented drink that is clinically proven to actively help your body reduce blood alcohol faster and boost mental clarity within minutes. And unlike other recovery stuff that just helps you feel better a little bit later on, this is supposed to work quickly. Look, I live in the Midwest, where day drinking on the driveway with the neighbors, well, that's a thing. So we tried it out, and I have to say that it worked great for all of us last weekend. So beyond their unique product, they've got Todd Gibson involved. He was a key guy in building Monster Energy into a huge brand. The stock is currently trading under $1 per share, which some people compare to where Monster or Celsius were early on. Given the product and the market they're in and the experienced leadership, it feels like it could be worth taking a closer look. So feel free to check out the link down below to learn more. The next company is Meta, also known as Facebook, Instagram, Threads, and WhatsApp. Let's go ahead and dive into the numbers first. In the latest quarter, Meta booked $42.3 billion in total revenue, up 16% year over year, with an operating margin that jumped 5 points up to 41%. The key item of growth happens to be advertising, which is up 16% and makes up over 97% of the mix. And then we have payments up 12%. And the major dog of the group is Reality Labs, which happens to be down negative 6%. But thankfully, it only makes up 1% of the total mix. And here's how Meta is planning to widen their lead. First, they happen to have AI-powered ads. The Advantage Plus and Meta AI models push better targeting. For example, their Reels conversions alone are up 5%, which lifts CPMs without flooding users with more ads. Then they also have new real estate to monetize even further. Their WhatsApp business payments, Instagram shops checkout, and fresh ad slots within Threads all add high margin surface area. And then they need to keep Reality Labs a little bit on a short leash. I mean, smart glasses are selling, but the CapEx is really capped until AR/VR traction proves itself, limiting the drag on the consolidated margins. So let's go ahead and move over to the forecasts. For the 1 year, the analyst consensus is at $699, up 15%. And then for the DCF model, we have $625, up 4%. Then for the 3-year projection, it has it at $790, up 32%. And then we'll round out the 5-year with a $998 projection, up 67%. Without a doubt, Meta is the definition of a cash cow, and their leverage of AI within their ads is really paying off. So long as regulators don't break up the Zuckerberg empire, I think this is definitely going to be one that's going to continue to beat the S&P 500 on all 3 timeframes. Our next company is Amazon, which we all know as the everything store, the cloud behind the internet, and also the ads that you didn't really know were ads. We'll jump into the top revenue drivers, with advertising having the most growth at 19% year over year, but it's only 8% of their mix. Then we have AWS, which is also their cash cow, driving revenues up 17%, with nearly 19% of the mix. It's obvious that the retail arms are slowing down quite a bit, so they're going to need to work hard to optimize everything within that supply chain. And of course, AWS still prints the fattest checks with a 39% operating margin, lifting the total company-wide margin up to 11.8%. That's up a full point year over year. So what exactly does Amazon need to do to keep the growth on track? Well, they definitely need to keep focusing on generative AI on AWS, because they've got Bedrock, Q, and custom Trainium 2 chips that let customers roll out large language models without buying their own silicon. That's what really helps keep AWS revenue growing in the high teens while margins still stay north of 35%. Then there's the ad flywheel. And brands absolutely love Amazon's full funnel effect, which we all see with that 19% year over year growth on ads. And it's now $13 billion in a single quarter. Honestly, that's Google-like margins. And it's truly that golden ticket that just keeps subsidizing retail. And the last main driver with them is Buy with Prime and 3P services, where Buy with Prime is letting external sites really plug into the Prime logistics and turn the fulfillment network into a toll road. Every package that avoids Amazon's own storefront will still pay the company. And I've shared this insight many times before that Amazon really has no desire to be in retail. What they really want is to be the product search platform and the supply chain for all other companies that have to utilize. I guarantee you that in 10 years, the retail portion as 1P, where Amazon owns the inventory, is going to shrink to nearly nothing. And I can say this because, well, I used to work there. And there's a lot more margin to be made in the product search platform and the infrastructure for the supply chain. Now, when we look at the forecasts, analysts have a consensus of $241.87, up 24%. Whereas the DCF model came in at $240, which is also up 24%. And for the 3-year, it has it at $287.76, up 54%. And lastly, the 5-year is at $344, up 85%. My quick take is that Amazon's retail business is going to ebb and flow. But AWS and that ad business driving all the margin, those are the two engines that are under the hood that's going to be driving all of the sales revenue and the margin. With all those levers cranking for Amazon, I honestly believe that it'll outperform the S&P 500 in the 1, 3, and 5 easily. Now we're going to shift over to Apple, which is the premium brand among the group. But this brand has been hit pretty hard lately from tariff talks, a lackluster effort into AI, and their investments in the electric cars and the AR headsets, well, they were kind of duds. When we look at revenue, the iPad growth was the surprising leader, up 15% year over year, but at a pretty low mix of only 6%. And the next highest growth engine was from services, up 11%, with a healthier mix of nearly 28% of the total revenue. Thankfully, their App Store, Apple Pay, and the fastest growing ads business pushed services towards a $110 billion annual run rate. And every extra dollar drops at a 76% gross margin, which is totally insane. And I'm sure many of you know that they have recently shifted to a Made in India initiative, where they're working pretty hard to diversify their assembly out of China to cut tariff risk and eventually trim some freight costs, padding long-term margins, but I don't expect that to truly hit until next year. Now let's move on to the 1-year forecast, where it's at $228 from analysts and up 15%. Then my DCF model is at $218, only up 5%. And the projection on the 3-year is at $252, up 23%. And lastly, the 5-year is at $294, only up 43%. My quick take is that Apple's hardware is a little bit slow at the moment, but it is steady. And the real story is in their services, plus that AI-driven upgrade cycle that's truly going to fatten their margins just a little bit more, hopefully without cranking up their capex. And if tariffs and antitrust fines stay containable, then I'm betting that Apple will easily edge past the S&P 500, but just barely. Next is Nvidia, and they are the engine that's driving every AI workload on the planet, where in looking at the top revenue drivers, its data centers are up 93% year over year, which I've spoken about a ton in the past year, and it makes up over 90% of the total revenue mix. Then we have the ProViz area, which is the next top growth, up 45%, but it's a very small part of the mix. And it's shocking that their consolidated gross margin hit 75%. And that's up 3.8 points just year over year. And that is exactly what triple-digit data center growth does for a company's P&L. And I've also mentioned that margin is their biggest risk at the moment moving forward because they are already at the very top of their game. Since I talk about Nvidia all the time, I'm going to shift straight into the forecasts. Analysts have the 1-year forecast of $164, up 39%. But the DCF model only has it at $150, up 27%. And the 3-year model is at $220, up 86%. And lastly, the 5-year is at $300, up 154%. I think it's a good reminder that Nvidia isn't just selling chips. It's selling the picks, the shovels, the rail cars, and software for the entire AI gold rush. As long as other companies keep signing those huge 9-figure purchase orders, and of course, if Washington doesn't slam the door on the exports, then I definitely feel that Nvidia is going to blow out the S&P 500. Next, I'm going to shift over to Tesla, which we all know is an EV pioneer. They're a battery behemoth, and maybe even your next future robotaxi. I'm going to jump right in with their revenue mix, looking quite a bit lopsided. And I'll call out that their energy storage is up 67%, but it's only 14% of the total mix. And of course, their automotive is down negative 20% year over year, with making up the majority at 72% mix. And the automotive has been a total dog this last quarter. And honestly, I think it's going to continue for the next couple of quarters in the least, just based on buyer sentiment. And of course, it is in their playbook to drop prices when times get tough, which forces the margins to really bottom out. That record's been played several times before for them. And if you are not aware, the next big growth for Tesla happens to be the full self-driving and also the robotaxi network. The paid autonomous rideshare start in Austin in just a few months, and widespread launch is supposed to follow in 2026. And if it works, software as a service margins land on every vehicle, and it would be very powerful. Then we have their Megapack backlog, a dedicated Shanghai megafactory, and the Lathrop line aim to clear soaring utility scale battery demand for a segment that's already growing 67% year over year. And earnings are way higher than selling cars. And then you have the Optimus humanoid robot. Musk wants thousands working in Tesla plants by the end of this year, and 1 million unit annual production within 5 years. Definitely a moonshot, but it's one that could dwarf vehicle revenue if it sticks. This is one area where we have a lot of hype, and we should have a lot more concrete details coming into Q2 of this year. And if there is any truth to the hype, then the stock has massive potential. So let's jump into the forecasts. And I have to state that the discounted cash flow model just doesn't work for them. It has the stock price consistently at the 1, the 3, and the 5 years, all below $100. The model just doesn't work or account for major innovative change. So, as a backup, I used a simple method of keeping the PE ratio constant at a 74 for all the timeframes and forecasts. This is probably going to be a lot closer to reality for them versus the DCF model, but it's also giving Tesla a lot of credit for innovation that may or may not happen. The one-year analyst consensus is at $284, which is a negative 1%, and the PE target forecast comes in at $256, which is a negative 10%. And that 3-year forecast comes in at $377, up 33%. And lastly, the 5-year comes in at $488, up 72%. Look, in the short term, their car profits are sinking, and their sales for cars are sinking. They really need to lean heavily into FSD and also into the robotaxis. If they can get those items going, they stand a chance. But the reality, in the 1 year, I don't think they're going to meet or beat the S&P 500. Now, on the flip side, I do believe that they will do quite well at the 3 and the 5 year because they're going to be doing a lot more in the megapacks, and also those robots should hopefully be making an impact. And please, keep in mind that Elon had announced full self-driving would be a reality by 2020. Oh wait, and then 2017. Oh, and then the goalposts just keep moving from there. Now, before I compare all of these companies together, I do want to showcase and compare the cloud services between Amazon, Microsoft, and Alphabet. And as you can see, Amazon's AWS is the king in share last quarter. But Alphabet is growing the fastest, while Microsoft is making the most profit. And you can probably come to the same conclusion as me, that with Google's operating margins being the lowest, they're really just trying to buy customers, and honestly, it seems to be working. It's worth noting that this space is often one of the highest margins for each of these companies, and they all want to grow this piece of the pie the most. So for that reason, it's an area that we're all going to want to watch for every earnings call. Now we'll take a moment and we're going to compare all of these companies with the best short and the long-term growth potential. I happen to use a weighted methodology to objectively rank each of these companies, and we come in with Nvidia at the very top of the pack, and it's followed by Google, Amazon, Microsoft, Meta, Tesla, and Apple fell to the very last place. Like I said, I tried to be as objective as possible in how I forecasted and ranked each of these companies. So my question to you is, would you have ranked them any differently? And I'd love to know why. And I already know that there are going to be a lot of die-hard Tesla fans out there. They're going to want it at the very top. And that's absolutely okay. Just give me a reason. But I also want to point out that I had to give Tesla a lot of extra credit just to keep them in play with realistic forecasts. Like I said, let me know in the comments how you would have specifically ranked them. And it goes without saying that at the very beginning, I mentioned that these are all fantastic companies. And my whole point was, how would I rank the top 4? And now you can see how. And I'd love to see, how would you rank your top 4? As always, thank you for watching.